All right, today is Wednesday, November 11th. This is the 2 p.m. section. Recording is on. Today, we're going to talk about the rest of the Merck valuation in just a couple of minutes. And also mention homework 10, which has been posted on United Airlines due Monday. And then a week from today, you will be presenting your CVS Health valuations as group case 3, 10-minute presentations per team. Sorry, my dog is going crazy there in the background. So as we get started, one other thing I want to mention too is if you're not paying attention, the virus is rampaging again. I think infections are up 37% last week. We've had 10 million people infected since November 1st, and it's really getting out of control nationwide. Hospitals are filling up. It's going to be very much a tragedy. I know they've talked about a potential vaccine, but that's 6 months away. So realistically, just please be safe out there, particularly as you think about going home for Thanksgiving or anything. Ahead. So just be all right. So today, we want to talk about Merck. There we go. We want to talk about Merck. And before we do the bull, the bear, and the target, somebody tell me what you learned. So as you guys did research, what did we learn that might be relevant to that conversation about Merck? Feel free to just unmute yourself and let's have a conversation. What did we learn about Merck?
I guess I'll go into some of the stuff. So they have Keytruda is one of the main drug they offer. That's supposed to be valued at about 21 million in about 2 to 3 years. They also are the same company that created the Ebola vaccine. So even though they are very short, like they're only in like stage 1 of their trials for COVID-19, they are the company that created the Ebola virus fixer-upper. And they also were in the early stages of getting better drugs for HIV/AIDS. And some of the analysis I saw for their pharmaceutical. They're also involved in animal care. That's only like 4% of their actual business.
Yeah. So I think you brought up really good points. Animal health being one of the bigger drivers of their business, but Keytruda, which is becoming one of the best-selling drugs in the world, is kind of critical. And investors are worried about, I guess, what they're calling concentration risk, because that drug is becoming such a large part of their sales. If anything happens to it or eventually gets off patent, that is a risk to the business, right? The other thing that Brandon mentioned is they are late to the game with COVID, but they do have 2 promising COVID drugs as well. They're further behind the Pfizer drug, but the Merck drug has 1 potential benefit, actually 2 from their perspective. But what were the benefits of the Merck COVID drugs over, say, the Pfizer drugs that might help Merck?
Can you repeat your question?
Sure. Brandon mentioned that Merck has 2 drugs in the stage 1 pipeline for clinical trials for COVID, to cure COVID, or at least our vaccine for COVID. Right? They're behind. Pfizer's got 1 that could launch 3 to 6 months, be approved next month.
Are you looking for the fact that theirs would be single dose while the Pfizer one's like 2 doses every 3 weeks?
Yes, that's actually exactly what I was looking at, which is one of the things that could benefit Merck, even though they're late to the game, is the Pfizer drug requires 2 vaccinations. So you got to get 2 injections and go back at 2 separate times. Whereas the Merck drug is 1 and done. So even though they're behind, that could prove to be a popular option for a lot of people. The other thing about the Merck drug is they didn't receive any government money for it. So potentially they could make more money on it. Not saying it's good for public health, but at least it could be good for Merck. Not saying that they would take advantage of that, but those were 2 of the things the analysts had talked about. What else is going on with Merck?
I know that they acquired Velopis for 2.75 billion, which is an experimental cancer drug company.
Okay, so they're definitely making a big play in oncology. That's what they want to be known for and dominate as a business. Okay, so keep going. What else? What other things might matter to the bull and the bear about Merck?
On the analyst report, like they said, outside of COVID-19, that they weren't expecting like any major developments and like new drugs and stuff until 2023.
So a couple years off before they had any big potential new blockbusters outside of Keytruda. Okay, what other issues might matter? Because there's one other big one that you guys should mention. I haven't heard it yet. That affects Merck as a company.
I think they recently spun off their women's health and biosimilars into a new company, and they're now really dependent, I think, on Keytruda.
Yeah, so next year, it's actually gonna happen next year. They're gonna spin off a business called Organon or something like that, Organon, which is gonna essentially take the business and spin off their lower growth, not under patent, lower margin products. And they'll leave the main company, the mothership, with higher growth, higher margin products, right? They're also taking a lot of the debt and they're moving it to this spinoff so that the remaining company will actually have a cleaner balance sheet, okay, as part of the spinoff. And that will matter when we talk about our valuation. So if I go back to the spreadsheet where we were in class at the end of the day on Monday, this is section 201. I'm going to pop up the as is for this class and share it. Normally, again, this is why I worry about when you guys plug and chug, something should have jumped out at you on this ratio screen as we were doing the as is valuation that should have been concerning. And if you were giving this meeting a presentation next week, I would definitely have asked you about it. And I want to get you to focus your attention to row 7. What's concerning about row 7?
Their EBITDA seems unsustainable.
Yeah, and not just unsustainable, like this doesn't look anything in the future like it did in the past. That's a pretty substantial jump, right? And so I'm just telling you, if this were a presentation, I'd be asking you, all right, what happened? What caused that EBITDA to change so much and to be so much higher than it was historically, right? So what's the answer? Because this is consensus estimates. So Wall Street actually believes this. Why is it going up so much next year? What should we link it to? Somebody wrote in the chat, the Organon spinoff. Exactly. So that's one of the two reasons. This is probably the primary reason why their EBITDA is changing, because they're intentionally changing it by spinning off the low margin business. And on a weighted average, if you keep the high margin stuff and you get rid of the low margin stuff, your margins go up. And essentially that's what they're doing as part of the spinoff. And so normally you should be very suspicious about a jump here, but at least we have a partial explanation. The other explanation about why it continues to grow is Keytruda. Because Keytruda, which cures cancer, is $100,000 per dose. It's one of the most expensive drugs in the world, right? So that's the drug that, again, if you go to, for Merck, and you look at their earnings estimates, and we said that in the pharmaceutical industry, you could actually see sales by drug. And if you look at their sales by drug, Keytruda is going to become one of the most $20 billion a year in sales, one of the biggest drugs ever sold, single drug in the world. And the reason why, just to put in the perspective, you're going to do a valuation on United Airlines on Monday. Keytruda's sales will be bigger than United Airlines' entire sales in 2 years. So essentially, this is part of that growth. And this is a drug under patent protection for the foreseeable future. And that's also going to increase their margins, right? Now, there's some potential issues with Keytruda, and that is competition. Their biggest competitor is a Bristol Myers drug called Opdivo. And I think Genentech, which is part of Roche, is coming up with some competitors as well. So they're not going to be the only game in town, but Keytruda is the leading drug, right? And if you've never heard of Keytruda before, Keytruda is what's called immunotherapy. It basically uses your own immune systems to attack the cancer. And it got well known a few years ago because former President Jimmy Carter was diagnosed with a stage 4 brain tumor, who was told he was going to die. And they gave him the drug from, I think it was Opdivo, as the immunotherapy, and it cured him. Now he's now cancer free. So it's actually a miracle drug. It actually literally cures cancer. But unfortunately, it doesn't cure all cancers. And one of the things that happened a few years ago is that apparently you need an indicator called a PD-1 as part of your cancer for the immunotherapy to work. Like if you don't have the PD-1 marker, then you pretty much aren't going to be benefit of the drug. But if you have the PD-1 marker, the drug is highly effective. So when they were trying to do a readout for lung cancer, of which there are 7,000 people per year diagnosed with a certain type of lung cancer, at $100,000 a treatment, it's a $7 billion market right there. Basically, they did clinical trials against Bristol Myers, Opdivo. And what Bristol Myers did in their clinical trials is they actually accepted all of the patients with this type of lung cancer and just took them all into the clinical trials. Merck, you had to get tested to go in the clinical trial, and only people that had the PD-1 indicator were allowed into the clinical trial. So when the clinical trial results were reported, Bristol Myers didn't show that their drug did any better than chemotherapy, because for 2/3 of the people, it failed. And it only worked out about 1/3 of the people that had the indicator. Merck's clinical trial, which was only with the people, essentially the 1/3 of the population that had it, that would benefit, showed tremendous success in their clinical trial. So what ended up happening is Bristol Myers got a huge setback, wasn't approved for treatment, and Merck was not only approved for treatment, they were actually put as the first line of treatment for certain types of lung cancer. So that if you were diagnosed with cancer, historically, you had to go through a lot of hoops before you get to this $100,000 drug. CMS actually said, if you get lung cancer, you can go straight to the $100,000 treatment and we'll reimburse it. And that was really the explosive growth of Keytruda. What Merck is now doing, and Bristol Myers got smart and is catching up in their clinical trials as others, but they're now applying this to other cancers. So basically esophageal cancer, bladder cancer, prostate cancer. They're going through the cancer list. And so that's where you're seeing the potential explosion of growth for Keytruda and its competitors. So on the one hand, it's great to cure cancer. There's a lot of drugs doing this, and it's expanding into other areas. That's the upside. Downside is their competitors have figured out what they're doing and they're matching them. So they have other drugs, which are similar in class, that are competitive for this. So part of our risk assessment, we do our bull and our bear, is going to be a competitive analysis as well. But back to Keytruda, it's expected to grow dramatically, and this is a very high margin drug. So when they spin off the company, the growth in sales of the high margin drug plus keeping all the other high margin drugs leads to big increase in EBITDA. And that, by the way, is already baked into the current share price. Okay, so just important things to understand as we're about to go through the bull and the bear. Questions about any of that? So back to when you're doing your CVS Health presentation to me next week, I expect you to understand these types of details about CVS, right? Because you've been working on CVS for over a month. You had access to the CFO of CVS who spent a class with us, telling us about what they're doing. You looked at their segments. Like, we should not just be changing numbers. We need to be explaining why we're changing the numbers we're changing and what's the context of all of this, okay? So that's going to be very important to your assignment grade. So let's continue on. So I'm going to now do my bull for Merck. So make sure that I have my multiples for Merck in here. I did. So I'm now ready to do my bull. So file, save as my bull. All right, so what were some of the things that were associated with my bull case? Right, well, I'll go back to the headlines that we were just talking about. Number one, that Keytruda does get approved for other forms of cancer and continues to grow even more spectacularly than it already has. So that would be part of the bull case. The other part of the bull case would be, as somebody had mentioned, there are some, if you scroll down here to the bottom, there are some stuff early stage in the pipeline that are potentially, including the COVID cure, which I think is V114 here. But basically that could launch and become pretty substantial sales in the next couple of years, right? So if I were to add the blockbuster sales in the next few years of these launch drugs, how big could they get? Well, without knowing much, if I scroll to the top of the list, with the exception of Keytruda, which is an outlier, right? It's an outlier to the entire industry. There's no other drug as big as Keytruda in the entire industry when it all is said and done. A couple that are close. But the point is, these drugs are more like what a blockbuster traditionally looks like. So somebody said they have 3 or 4 blockbusters. Well, if they're all in the $1 to $3 or $4 billion range, that might add $5 billion a year in sales. Okay, so when I start thinking about my, my bull case by 2000 and 3 or 4 years out, Merck is going to be a $60 billion firm. I believe the sales by about 2024, 2025. Add another $5 or $6 billion of sales to that. That's about 10% bigger on the bull side. So what I'm going to do is I'm going to come in here, and instead of the 3.5% growth rates, I'm going to use about 7% growth rates in those out years to get me to about 65 billion in sales versus about 60 billion in sales. So if I look over here, my out years closer to 65, 64. Okay, so, and my story for why I'm getting more sales is what I just said. More Keytruda into other types of cancers. And some of those launch drugs do become blockbusters in the next few years, bigger than what's currently expected. Next question is, what happens to the EBITDA margin? Well, here's the point. Even though the blockbusters generally are high margin drugs, I don't think the EBITDA margin is going to get that much higher than it already is for two reasons. One, I worry about government at $100,000 a therapy already, worried about the price. And two, they're already getting at $100,000 per dose, pretty high margins. Doesn't cost that much to make the drug. They spend a lot on the R&D, but the drug itself is relatively cost effective. So here's the idea, which is from an EBITDA perspective, I don't think they're going to go up too much higher than they already are. It's more about more sales of the high margin as opposed to even higher margin sales than they're going to get because they're already pretty dominant with the high margin products. And it's much higher than it was historically. So maybe I'll give them, I don't know, 45%, but I don't see the margins going much higher. So the real driver here is faster growth. I don't think the tax rate is going to change anymore. And now, you saw Alaska called for the Republicans. We now have divided government realistically for the next several years. So the chances of getting a tax increase on the corporate side continue to go down. So realistically, even in my bull scenario, I think the tax rate does stay about where it is. So I'm okay with leaving it there. So then the other key assumption I'm going to make is I think that the G is going to be a little bit higher, right? And so I think the G is going to be closer to 3.5% per year versus 2.65, mainly because of what we just said. We have the blockbuster drugs and we have the new launch drugs plus the Keytruda sales. I don't think the competition really takes over. Merck continues on. That leads to bigger revenue. And then finally, I think the WAC is going to be a little bit lower. I think that realistically 7.5% is where the WAC is going to come down to. Because I think as the market starts to understand they have all these drugs under patent, that they're fairly dominant, they're fairly predictable, and that the cost of capital starts becoming closer to the Bloomberg cost of capital, not the higher one that JP Morgan was using. And so therefore, that puts me at a price of $139 a share, and that's my bull. Okay, so I save this, and I get ready to do my bear, but before I do that, I got one more step. What's my final step in the bull?
Check it against the multiples.
Exactly. I got to do my sanity check. So let's check what a 139 price looks like against the multiples. Those are the multiples for 139. That's the industry range. I'm now well above the industry range on just about every multiple compared to any of the peers of the large global pharmas. So even though I kind of like my story and it makes sense to me, I think I've actually become too bullish in its interpretation. So it's not saying the share price is going to be higher, but I think I've gone too high too quickly. So what I'm going to do on an assumption basis is lower my CVG to 3%, which is going to basically get me down to about a 127 share price. And at a 127 share price, maybe it's still a little bit on the high side. So I'm going to take my WAC to 8%, as opposed to 7.5. That gets me to 113. And at 113, okay. Now I start saying I'm at the top of the range, but I'm not well above the range. And going from where I am now to this would still be an aggressive improvement in valuation, but nothing crazy given what I've seen in the rest of the industry. Because I can still see companies higher than most of these. So I'm near the top end of the range. And I think that this is probably a more reasonable ball. Questions about what I just did before I get to my bear?
Do we explain what reasons will we give for for explaining why we changed the WAC and such? Will we just talk about how we wanted it to be more in the realm of sanity, or?
Well, let me flip it back to you. What if I switched it from 9 to 8? What would you tell me would be a reason to do that?
Okay, because the firm is getting less risky.
There you go.
Okay.
And so therefore, because they're getting more predictable and less risky, they probably will have a lower beta, and therefore will have a lower WAC, and that is more sustainable.
All right, awesome. Thank you.
Sure. But what he's saying is very important, like connect dots. just keep connecting dots, use numbers, and connect the dots as you go along the way as you explain the scenarios. So what I don't want you to do is just say, well, I'm going to lower the WACC and raise the growth rate and change the margin a little bit. Like that, obviously mathematically, sure, you did that, but like why? If you're just randomly changing numbers and I don't have any context for the changes of the numbers, that's what's going to be very ugly for your grade next week, right? And so that's why I wanted to go through class today and just say, look, do some research on Merck so that you understand the context by which I'm changing the numbers, right? Because that's going to be very important to your CVS valuation. And another example of this is if you actually read through the analyst reports, like this is the Mizuho or actually that's not the one. This is the Mizuho analyst report for Merck. It was the very first one on the list. Where are they? Here it is. Under BRC. And if you read through this, blah, 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 you'll notice that what they're doing is they're saying, okay, here's what I think is going to happen to their numbers. Here's my comments. Here's what I think is going to happen as catalysts for their drugs. Here's what I think is going to happen in 2021. And here are the things that are important. And here is my valuation of Merck, which is a 4-year DCF. And here's all my risks, which they list, right? Now, what Mizuho did not do, which I would have appreciated, is they didn't take these risks, these 10 risks that they list, and turn them into quantifiable prices, right? So they leave it up to you, if you read this report, to say, okay, our price target's $100. Here's what I think could change it. And it's up to you to figure out what the bull and the bear is, right? The better banks are increasingly doing that for the buy side. So what they'll do is instead of just listing the risks, which are great, then they go to the next step and they say, okay, these risks will lead to this price target on the high side. These risks will lead to this price target on the low side. So you get your range. Okay, so I'm just giving me a target, I get a range. That's what I'm requiring you to do in this class. So, but the one thing they do, what you need to do, is they list the key issues that are going on with Merck so that we're tying it to what's happening in our range. Okay, because these assumptions are important to understand what's going on with the stock price, right? And that's what makes you better at valuation and a better analyst. Okay, so coming back to here, I'm a little bit more comfortable with my bull for that reason. Other questions? I'm going to then go to my as is for Merck and file, save as my bear. Right. So given what we talked about with Merck, what could be my bearish assumptions? Well, one of my bearish assumptions back here to revenue is that these margins don't improve nearly as much as people expect. And part of the reason is that they don't get the blockbuster drugs launches that they were potentially there. They kind of fizzle a little, and or regulation. Because as I said, despite the continuing fights between the Republicans and the Democrats, they seem to agree that drug prices are too high. And drugs that are this big, like Keytruda, are going to increasingly get attention by CMS and by the US government. And that's a Center for Medicaid and Medicare Services. They're the people that basically buy on behalf of the government and set the prices. But the point is, I think that there could be some pressure even on this high price drug, even though it's under pressure, under patent protection. And so therefore, revenue isn't going to be as great. Maybe it's going to be flat. And Ebitda margins are going to fall. Maybe they'll fall to 40%. They may not fall back to the 30s because they got rid of all their low margin stuff, but their margins aren't going to be as high as I expected. Okay. And I do think that the tax rate's not going to change. So I'll leave that even in my bear scenario. And I do think the WACC is not going to come down. I think that people are going to still perceive the business as more uncertain and more risky going forward. So I'm going to leave the WACC there. And I might lower my CVG to 2% a year versus 2.65 to reflect that lower growth, giving me a bear price of 65. Sanity check that. Well, even though this starts to look pretty ugly, bear is already trading below this range. So therefore, I think it's actually entirely possible they could look like a bear Bristol Myers is below this range. They could look like a Bristol Myers, and that actually is a reasonable bear. So I now have set my range. This is my bear with a price of 65. This is my bull. Too many spreadsheets here. This is my bull, which is a price of 113. And then just the question is, where along this range do I think they're going to end up? That would be my target. Okay, to create my buy, sell, hold. Now, personally, I actually am more bullish than bearish on Merck. I think they're more likely to come to the bull side than the bear side. So I'm going to start with my bull to get my target price. So save as target. And I think the growth rate might be higher, but it's going to be something like 4.5%. I think that the G will be not 3, but that the WAC, could be the bull scenario. Okay, here we go. So I think that the EBITDA margin, 45% closer to the bull, is probably going to be more like the 44. I think the 4.5% growth. I'm okay with the tax rate being around 15.5% because I don't think Congress is going to change that with a divided government. I also think that the G at 3%, maybe 2.8, a little bit less, but still positive G, putting me, and I'm going to use the WAC of 8%. I think that's actually a more reasonable WAC because I do think that Merck will still be a little bit more predictable, but still above the cost of capital that the industry is trading at. And I'm okay with a target share price of 103, which is more than 10% above the current share price, which then 103 minus 84 tells me it's a buy. So I put a buy on Merck for the reasons that I just said. Again, short period of time, pause, questions. Because what we're doing, RV, if I look at my spread, is I am saying that the industry WAC, which is around 6, is still not the WAC that we're going to use for Merck, which there's around 6. It's closer to 8. And implicit in that assumption is the idea that with that higher WAC, basically a higher beta, right? Because if I were to go to the beta screen, it's part of what we talked about on Monday, Merck's beta, which Bloomberg uses the adjusted beta to calculate the beta and the CAPM at 69, I'm saying it's going to be closer to 1, right? So what I'm really saying is that the historical beta does not represent the forward risk of Merck. That's also what JP Morgan is saying, okay? What they're really saying is the past is not the future, right? Because one of the challenges we use with WAC is we're using historical betas to drive current cost of capital, right? And everything we said at the beginning of this class said that there's more uncertainty with Merck. There's uncertainty of the launch drugs and how big they're going to be. There's uncertainty of Keytruda in terms of its pricing relative to the government and how many new classes they get in. There's uncertainty with the spinoff and whether or not it's going to be as successful after the spinoff. There's uncertainty with competitors, which are going after their oncology drugs. Uncertainty, uncertainty, uncertainty. Those uncertainties suggest more volatility in the future. So I think what JP Morgan is really saying is I just don't believe the historical beta. I think that their forward beta, predictive beta, if I were to do an E analysis, it's not going to be 0.69, it's going to be above 1. And using that, I get to a hurdle rate that's closer to 9%. Now, what am I really saying in my final target scenario? I'm saying that the beta, though higher than it's represented historically, won't be as high as people worry it's going to be. And so therefore, I think Merck will be a little bit more predictable, though still more volatile than historically. And so therefore, I'm using a cost of capital of 8%, not 9, but still higher than their historical beta. So both of us in our assumptions, JP Morgan and Professor Perfetti, are saying that I don't think the past is a good indicator of the future, but I'm backing it up with rationales similar to what Mizuho had listed here as the risk assessment for the company. Those are the uncertainties being quantified. Questions? So you're going to be doing this as your next assignment on United Airlines. And United Airlines will be a challenge, just letting you know in advance, for a different reason. Okay. So CVS Health and Merck are a challenge because the cost of capital for both companies, therefore the risk of the growth of companies, was probably different in the future than it is in the past. And so therefore using their current Bloomberg WACs to represent the future values may not work as well with our models, and we may have to adjust that. And we addressed that, which was different than the retail business when we looked at Target and Walmart, by using this as an example for Merck. And I'm letting you know you're going to have to deal with something similar when you get to CVS Health for your group project for next week. United is going to be a challenge in a different way. Okay. And I'll show you United's challenge here in Bloomberg. So you're going to value UAL, which is United Airlines, and their challenge is cyclicality. This is their forecast for revenue. Last year, 43 billion. This year, 15 billion. And then 26, 35, 39. Last year, Ebitda 6.8, this year, -6. So when your revenue falls by 60 or 70%, that's a different type of valuation issue you're going to have to deal with. And so for United, it's really going to be a question, particularly in your bull and your bear, about what this recovery looks like, right? And there's a lot of uncertainty in this recovery, but that's what you're going to have to address when you do United, because United is not a relatively straight line. United is like this. It's almost like a sine, big sine wave. And so that is just tougher to do in valuation. And that's what you're going to deal with when you get into the United valuation for Monday's homework assignment, individual assignment, which we'll talk about on Monday. But just giving you a heads up on that one. All right, questions about United? Questions about Merck?
Just to confirm, our presentations are on Wednesday, correct?
Wednesday, 10 minutes. Presentations due Wednesday, 10 a.m. And then, so two last things. And I want to use the Merck as is to illustrate a point that came up in one of the earlier classes that I think was just a good question to repeat here. Because part of the Organon acquisition or spinoff, Merck has said that they're going to do a special payout to shareholders, could be as much as $8 to $9 billion. So here's the point I want to make. When you do a big share buyback, so let's say in 2021, okay, they're going to spin off Organon and use some of the proceeds, the cash that they have, to pay a special dividend to their shareholders. Okay. Does that affect the share price of our valuation? And does that affect the CFI? So if I were to do a share repurchase in 2021 of $5 billion, what happens to my CFI? What's the balancing part that gets my CFI to get back in balance by $5 billion? How do they balance it? So again, they take a $5 billion share repurchase next year, reward the shareholders as part of the Organon spinoff. How does the CFI balance? Where's the money come from?
Excess cash.
So they have enough excess cash because they're changing excess cash is it's increasing by 8.7 billion. So what they do is instead of increasing their excess cash by 8.7 billion, they take 5 billion of that and they make that the share repurchase. Notice what happens to the CFI. It is now in balance again. Does the value of the firm change when they do a $5 billion share repurchase? Well, here's our DCF. When we repurchase $5 billion of the stock, what did this change? The answer would be no. And why didn't the operating value change? Because what's the operating value based on? Free cash flow. And when we did the share repurchase, did this change?
No.
No, it did not. This is Modigliani Miller in action. There's a reason why for years 2021 through 2025, I told you, don't worry about share repurchase, dividends, debt, because they don't matter. They don't matter to the valuation. It is a different question. What matters to the valuation, what drives the value of the firm is the free cash flow. Buying back stock does not change the free cash flow, so it doesn't change the value of the firm. What it changes is how we distribute the free cash flow. So what I'm doing is I'm giving it to one stakeholder versus another stakeholder. So instead of giving it to a bondholder, I'm giving it to a shareholder. So there's a second question that we get caught up in, which is the payout question of how we pay it out. Okay, but that's separate than what is available to pay out. And in this class, we don't care how you pay it out. Let other people argue over how you want to chop up the 14 billion. But you got 14 billion to chop up, and that is it. That's also highlights another misnomer in the real world, right? A big lie, even bigger than some of the political lies being told right now, is that when you buy back your stock, you're buying it back because you have confidence in your firm. That is ultimately just bullshit. It is a big lie. It's actually completely untrue. Buying back your stock is not confidence in your own firm. Matter of fact, Stern Stewart calls it an admission of failure, right? And I can prove that mathematically. Look at here, if we were to buy back $5 billion worth of stock, right? How can I say that that's not reinvesting in your firm? What's reinvesting in your firm on the CFI? What would actually be reinvesting in your firm? Not the share repurchase. What would it be?
Gross investment.
Yeah. You want to reinvest, put it in CapEx, put it in gross investment, put it in to your expenses in R&D that would affect your gross cash flow. Put it in something operating. That would affect your free cash flow. And that would actually affect the value of the firm. When you're buying back stock or paying a dividend, you're not investing in yourself. You're actually giving cash to somebody else so that they can take that money and go put it someplace else. How's that confidence in your firm? If you had confidence in your firm, invest in your firm. Invest in, I'm going to have more future sales here. Keep your money here. Don't just give it away so you can go put it into somebody else. So don't get me wrong. I'd rather you, if you don't have a good use for it, give it to me. So why do people do this? Why do people actually buy back stock? Why do they pay out the big dividends? And I'll say 2 reasons. Number one, there's a signaling effect, right? And the signaling effect is around bribery. Okay. Just think of it this way. I tell you, as the owner of Merck, that your share price is going to go up. You should hold on to your stock and get excited. Okay. Versus, here's a bunch of cash in this bag. And then I tell you, your share price is going to go up. Hold on to it. Which of those two do you think you're going to have a more positive emotional reaction to? Just take my word for it that this company's going to go up, or here's a bunch of cash. And oh, by the way, the company's going to go up. That second thing, that's the signaling effect. Even though they could both mean the same thing to the company, people tend to like having cash in hand. So there's the signaling effect of actually having the cash that I think is more psychological that people like to have than just giving me an empty promise. That's one of the reasons why people buy back stock. But there's actually another reason, which is increasingly senior leadership think the CEO, their compensation is tied to the performance of the stock. And they're now rewarded as a bonus in one of 2 ways, either earnings per share growth or stock price increase. Well, how do I grow my earnings per share? Buy back stock. The more shares I buy back, the fewer the share count. Lower share count, same net income, EPS magically grows. So if you want to know one of the reasons why management wants to buy back stock, it drives their personal income because they're getting EPS growth even if the income isn't growing. And number 2, with less share count, guess what? Fewer shares, same pie, the price of the shares goes up. Even though the pie is shrinking, but it looks like the share price is going up, so you own a bigger slice of a smaller pie. But I don't care. My stock options are purely based on the price of the share. It's not based on the price of the pie. So there are artificial incentives to want to buy back the stock. But what I'm telling you is they don't change the operating value of the firm. They don't change the free cash flow, right? And I'm going to undo this just in my valuation. But this is a very important point. Somebody asked earlier, I just think we should illustrate. And you can see it here as we do our 3 valuations, because here's my as is, and here's the DCF, okay? And what's changing between my as is and my bull, and you can see on the DCF, is what's changing. On the left is my bull. That's my operating value. On the right is my as is. That's my operating value. What changed? What changed was the continuing value of the bull versus the continuing value of the as is. Why did it really change? It changed because we increased in the key value driver, the G, we lowered the WACC and we increased slightly the margin and the starting growth rate. So the point is the 4 key value drivers that drive the continuing value changed. That's what made the firm more valuable. Buying back the stock has nothing to do with this. And so the point is, once I'm more valuable, then I have more absolute amount of cash to distribute. So I'm not worried about how you distribute it. I'm just telling you that you have this amount of cash to distribute, where you used to have that amount of cash to distribute. So the extra 70 billion is why you're more valuable, the 77 billion more of enterprise value, which was driven by more operating value, which was driven by more free cash flow. That's real value, as opposed to I'm just going to rearrange the deck chairs and give you cash. I'm just taking the 317 and I'm chopping it up in a different way. That doesn't change the 317. So a little bit more insight into what happens with repurchase and reinvestment. Again, questions about any of this?
So share purchases are more just to increase the market sentiment or to make more personal income?
I'm just saying that's what's in it for management.
Yeah.
What's in it for the shareholders is I have, and look at my bowl, I have 317 billion to pay out. So because I have 317 billion to pay out, then that's the value to me as the shareholder. So after the debt has been paid, I get 286. So when we increase the value of the firm from 233 to 317, what I'm doing is I'm increasing the amount of cash that theoretically could be paid out from 210 to 286. There's $76 billion, literally more cash available to pay out. Now, if I don't owe it to anybody else, all that can be paid out to the shareholder, and therefore you are better off. Right? Now I have a choice. I can either give it all to you now, or I could say, you know what, I'll take the 76, I'll put it back in the business, and I'll turn 76 into 150. That's reinvestment. But the way I turn 76 into 150 is not giving it to you. I change 76 into 150 by putting it in to gross investment, which makes the free cash flow better. That's how it would actually make the firm more valuable. Okay. Giving any money to a stakeholder, debt, equity, preferred, minority shareholder, that does not change the free cash flow. That does not make the firm more valuable. The only way that makes it more valuable is if you use that cash to make the free cash flow bigger. CapEx, increase in working capital, expenses that lead to more sales. That is what actually makes the free cash flow bigger and theoretically gives me more cash to be able to pay out. Now, what I don't want to do is I don't want to throw money down a black hole. I don't want to basically take the cash and invest it and hurt my free cash flow. So I put in gross investment and I don't get it back. So I'd much rather you give it to me than make a dumb investment. And I'll reward you for not being dumb. Because there's a lot of dumb managers out there. Make sense?
Yeah. Thank you.
All right. So last point, and then we will end our class. I put into the files folder, preview of what's coming up in the multiples, a folder called KVD Sim. I'm going to open up this Excel file. Key value driver exercise. So in the key value driver exercise, is a variation of what I showed you in the first day of class. So copy here for section 201. All right, so this is a version of the key value driver formula. Okay. And first week of class, we did the key value driver simulation. We said these were the 4 scenarios of a company. And we said, if basically you had no plat times 1 minus G over ROIC divided by WACC minus G, it's key value drivers formula. And we said, look, if you grew your company faster, your G increased, the value in the multiple didn't change because company A had a 0 spread, company B had a positive spread, so therefore it became more valuable. Something we talked about earlier this semester. We said the 3rd and the 4th scenario where what happens if company B's growth rate slowed, and if you grow a positive spread slower, this is the expectation cornerstone of repricing to a lower value. And if you grow a negative spread, then the faster you grow, the worse off you are. That's just repeating history, okay? The only difference is in the key value drivers formula, I'm going to make 4 substitutions. Substitution 1 is we're going to take no plat and we're going to replace it by net income. So instead of the total operating cash from operations, we're just going to do the cash to the income, to the equity holders. Instead of the growth in the cash flow, it's the growth in the net income. So the G becomes growth in net income, not growth in cash flow. ROIC in the key value drivers formula becomes return on equity because we're dealing with an equity cash flow. And WACC is, instead of discounting it at the WACC, we discount the cost of equity because we're discounting an equity cash flow. So basically it's the same key value drivers formula that we've always used. The difference is I'm plugging in equity numbers rather than plugging in operating numbers. Okay. So gives me similar results. The difference is this number down here is an actual PE. Okay. So what I'm going to do is I'm going to look at the S&P 500 index today. Okay. Now in Bloomberg, SPX is the ticker for the S&P 500. And if you go to the SPX index, this is the S&P 500 index today. Right now it's up another 18 points to 3563. Okay. And if you type in MEMB, these are the members of the S&P 500 index. Because what Standard & Poor's does is they basically pick 500 companies and they look at their share prices and they weight each one of those share prices. They multiply it by some percentage, and that will lead to, you add them all up, you get the index. So it's a weighted index. It's not just an adding up of the share prices. Okay? Now, going back, here's the point. They also do an EEO on the index. So based on the weighted analyst forecasts, these are the earnings per share of the S&P 500 companies. So basically, one equivalent share of the S&P 500 is $128 of EPS last year. The index is trading at 3564 divided by 128 of EPS is a PE of 27.85. Okay. So right now the S&P is trading at about 28 times last year's earnings, right? Now on a forward 12-month basis, it's going to have $158 of EPS. So on a forward PE, 12 months, 2251, and year plus one, so this is 2021, full year of forecast, price divided by next year's earnings, 21 times, 20.98 times next year's earnings. Okay. So I want to kind of put this into our key value drivers formula. So the expected profit in the S&P 500, and I'll do year plus one, which is 2021, is 169.91 as of today. The book value of equity next year is 1,010.47 a share. So that the expected return on equity in the S&P 500 index next year, net income divided by equity, is a little under 17%. That's the expected return on equity on the market next year. The cost of equity, CRP, country risk premium, this is the equity risk premiums Bloomberg is backing into for the S&P 500. Right now, for the US, it's 8.634%. Taking the key value drivers formula, copying it over, price to earnings multiple, price divided by earnings. That would suggest a PE of 11.58 and an index value of 1968 with no growth. So obviously, given that the market PE today, based on next year's earnings, is 20.99, let's move 500 up again while we're talking, 20.99, and the market's obviously expecting growth. Using our solve for growth method, is that 3%? Nope, it's gonna be higher than that, 4%, 5%, getting close, 5.5, so 5.4. There you go. So that is a representation using the key value drivers of the S&P 500 today. Key value driver equation. Because what it would say is at that level of growth, that level of return, and that level of risk, that would be a multiple 29.9, which says the index should be trading at 35.67, and the index is trading at 35.65. Okay. So two things that I wanted to mention here as we wrap up. 8.6, if you round off, is 9. 9 should sound suspiciously familiar. What's 9?
Was that the whack for Merck?
That JP Morgan used. So let me translate another reason why I think JP Morgan's using 9%. What JP Morgan is basically saying, and I hinted at this earlier, is that I don't think that the industry whack and Merck's whack of 6% is really the risk of Merck. I think, RV, go to Merck. I think what they're actually saying is that the beta for Merck is too low because the past is not representative of the future. That the risk and the volatility is going to be higher in the future relative to the market than it is today. So what they're doing to get to a 9% whack, I drill down, is in CAPM, instead of using a beta of 0.69, they're doing something like using a beta closer to 1.1, which will put, actually it's probably more like 1.2. Which will put, actually 1.2, probably actually the right answer. Which will put the whack closer to 9. So what I'm saying is that what the market is doing with the pharmaceutical companies, and this is relevant to your CVS Health valuation, is they're basically saying the past is not repeating itself. The future looks more risky than the past. And so therefore, however we're doing it, we're valuing them closer to a market cost of equity rather than across all 500 companies, as opposed to an industry cost of equity right now. So I think they're closer to a risk level of the marketplace. Or another way you could say this is maybe they are close to a beta of 1, and what they're doing is they're close to debt free. So if you have very little debt and you basically have a 9% cost of equity because you use the S&P 500, you get to 9%. In either case, I think that's what they're actually doing in the valuation of Merck right now. Okay, that's how they got to 9%. But regardless, this is also giving us some insight, which I'm setting up for the multiples analysis, to understand that the multiples give us implicit WACs. And when we start looking at those multiples, we can start seeing what kind of WACs have to be used. Because if we know the growth and we know the return, we can solve for the WAC. Just as if we know the WAC and we know the return, we can solve for the growth. And because the puzzle has to fit together. And I think the market is using a little bit higher cost of capital for the funds. It's just another way, and it's actually closer to the S&P 500 average than a pharma lower risk discount, because they perceive more risk in pharma. Again, I threw a lot at you really quick. Questions about any of that? Then if no questions, homework 10 is posted. Yes,
I have a personal question. Can I ask it after?
sure. Homework 10 is posted. It's on United Airlines, individual assignment, as is bull bear target. And again, 500-word write-up with assumptions. And then start working on the CVS Health if you haven't, which is due next Monday. Okay. Talk to everybody on Monday's class. We'll go through United. Have a good weekend. Stay safe out there. There's a virus.
Yeah, they just canceled the football game.
I think you're going to see a lot more cancellations beyond the fact they told you not to come back after Thanksgiving.
Yeah, well, Maryland just had 8 players test positive.
We did what? Positive?
Maryland just had 8 players test positive.
Oh, that's just